Welcome to our quarterly State of the Markets. A lot of things going on today, as today is the first day in the market after the tariffs were announced yesterday. So we'll be diving into an update of the first quarter in terms of what happened in the economy and in the markets, but we'll also talk a little bit about tariffs. And the reality is that it may be a little dated by the time you get it here in a few days, but this will be an ongoing conversation that we look forward to having with clients as we see the rollout of the tariffs, ups and downs probably in stocks, and what it means for your portfolios. So with that, I'm going to turn things over to Austin, who will recap the first quarter of the year.
Thanks, Spencer. So as we look at the first quarter of the year, we're looking at index returns from January 1st through March 31st. So if we look at it, the U.S. stock market as of the close of business on March 31st was down about 4.7%. International stocks, they came into the year getting hit by the anticipation of tariffs. They've done a lot better in the first quarter of this year so far, up about 6.3% as of the close of business on the 31st. Emerging markets up about 3%. Fixed income in aggregate up about 2.8%. U.S. Treasuries up about 2.9%. And then municipals are down just a touch. Global reinsurance, obviously, it got hit a little bit in that first quarter of this year by the LA wildfires. But that aggregate is up about 1% for the year on that index. As we look at U.S. equity returns in those different sectors, if we look at large cap versus small cap, large value versus large growth, U.S. large cap stocks were down about 4.5%. Small caps got hit significantly harder, down about 9.5% through the first quarter. The bright spot on this is large value, up about 2.1% so far for the first quarter. Again, not including what has happened in the last few days, but then we see large growth down about 10% for the first quarter. As we look at the international developed equity returns, this is where we really see diversification helping so far this year. International large caps up about 6.5%. Small caps on the international side up about 3.5%. If we look at large value, has significantly outpaced international large growth, up about 11.2% versus large growth up about 2.1%. If we look across the fixed index sector, we look and see, again, the U.S. aggregate bond market up about 2.8%. If we look just at the treasuries, the United States treasuries, those were up about 2.9%. Those treasury inflation protected securities up about 4.2%. If you were shorter on the duration for U.S. treasuries, you were up about 1.6%. Longer term treasuries, you were up about 4.8%. Again, as interest rates start to fall, those prices of the bonds are going to move up. U.S. high yield corporate bonds were up about 1% versus U.S. corporates just in general up about 2.3%. The U.S. municipal bond market was one that was down a touch. And then global reinsurance, again, up about 1%. Again, reinsurance is not one that we would say is necessarily a fixed income strategy, but it's going to have a little bit more or less volatility. There may be more volatility than the bond market. There may be less. But again, we put this here, position it as opposed to against the stock market. So reinsurance up about 1% so far this year to date in terms of the first quarter. If we look and we see what the bond market has done, that dark blue line is where the interest rate yield curve ended at the end of 2024, whereas that light blue line is where it is sitting currently. So again, as we see on that far right side of the line, where interest rates have dropped on the 30-year treasury by about 20 basis points, 0.2%, that is where we've seen some of that price movement on those longer term treasuries. Again, when interest rates fall, the prices of the bonds are going to go up. So we've seen in some parts of the yield curve, again, that interest rates are a little bit lower. In some parts, they're about on par with where they were throughout the yield curve as of the end of the year. Finally, for this piece, we're going to look at asset class valuations. Again, these are the Z-scores based on 20-year average valuation measures. If you care to see what those are measured against, it could be anything from forward price earnings to the price to book to the yield to worst. And so all of the rationale behind where JP Morgan got their data for this, it's all down there at the bottom in the disclosures if you want to see. But what we're looking at is, are stocks, are bonds, are they more expensive or less expensive than their 20-year average valuation. And so if we look at the United States Treasuries, if we came into the year, it's going to be those figures in gray versus where we sat at the end of March in 2025, the end of the quarter. So as we came into this quarter, so U.S. Treasuries were cheap on a price on their average valuation. So they were about one standard deviation below. They've stayed right in that line a little bit. Again, because they've had a little bit of price movement upwards as interest rates have fallen, they're still cheap relative to history, but maybe not as cheap as they were at the beginning of the year. Municipal bonds, you can see, moved from negative 66 to negative 0.08. So we're getting a little bit closer to that 20-year average valuation. International developed stocks have stayed about on par with where they were coming into the year. Small cap, as you can see, based on where that big hit was throughout the first quarter, they are now cheaper on a price to earnings, price to book basis. They're getting a little bit closer to that 20-year average. Investment grade bonds across the US are about the same, a little bit more expensive than their 20-year average. US value equities, maybe a little bit higher valuation, a little bit more expensive. Growth, US growth stocks, where we said at the beginning of 2025, they were coming in pretty expensive compared to their 20-year average. Well, because they've taken it on the chin, again, down about 10% so far this year, that's going to drop that valuation a fair amount, almost half a percentage point there. And then you can see as well the large cap equities. This, again, can come in about a standard deviation and a half above their 20-year average, where now it's about a standard deviation and a quarter above their 20-year average valuation. And so really, as we think about this, we don't know what is going to happen with economic policy moving forward. But what we can see is as the markets move, as stocks go up or down, it's going to change those valuations based on their 20-year averages. And so, Spencer, as we look and see these tariffs have been implemented yesterday, the executive order was signed. What do we need to think about when we think about tariffs going into the future, and especially that roller coaster of volatility with the stock market that we could experience?
Well, I think the first thing to recognize is that, just as you said, we don't know where things go. We don't know where they go day to day. Tariffs, I'll share three ideas here. But first is tariffs are like strikes. Worker strikes. Worker strikes are typically done to achieve a certain measure. Obviously, workers don't want to strike forever. They're not going to be paid if they strike forever. In a similar way, you don't really want to use tariffs forever. Any kind of economist would say tariffs are inefficient for various reasons. It's kind of like if you're playing a team in basketball and you have tariffs in place, you would basically both be saying, well, we're going to play with our left hand or our opposite hand here. We're going to put constraints on ourselves so that the game is not as pretty, is not as fun to play. But if you came into the game and you said, okay, the constraints are such that we're all playing left-handed and the other team is able to use either hand, this is not fair, then maybe you would work towards putting some tariffs in place to be able to level the playing field. But you only want to do that for a short period of time. This is not a good long-term strategy to be able to have high tariffs. A second thing would be that tariffs are going to make everything a little bit less efficient. So you can do this again for a short period of time, but the analogy here would be, if we ratcheted up tariffs, and let's just say that we're going to think about them with Vietnam. Vietnam people there, they make a lot of clothing there. Now, we don't make a lot of clothing here. Now, in Knoxville, of course, where we're from and film, of course, Knoxville had the Standard Knitting Mill right, a half mile down from our homes, and they made the underwear there apparently for most of the Eastern Seaboard at one point in time. This was in like the 1920s, I think, maybe the 19-teens and 20s. That Standard Knitting Mill was shut down a long time ago, has been in disuse and disrepair for many, many years. You could think about it this way. We in the United States, we're world leaders, I think, now in producing airplanes and such. So if we ratchet up our tariffs 100% on all of the imported, things from Vietnam that would be them making clothes and they put 100% tariff on all of the airplanes, what that's going to do is it's going to incentivize firms to set up operations in the United States to produce clothing, and incentivize firms in Vietnam to try to figure out how to build airplanes. Well, they're not nearly as good at building airplanes as we are, and we're not really interested, honestly, in bringing all of the clothing manufacturing back to the United States. Those are not high-income jobs. So we have to look at this just wide-eyed and say, tariffs are not going to improve the profitability of companies, generally speaking. There may be certain areas that the administration wants to bring jobs back to, in terms of manufacturing. Maybe they're high dollar jobs. You could even look at Japan. You could look at South Korea. Most of the manufacturing jobs, when we look at appliances and other things, they've moved away from those countries as well, because the jobs, they're difficult to pay people a living wage to be able to produce those kinds of goods. So it'll be very interesting to see how much, might be able to be brought back, what the end game, what the strategy might be here. But generally speaking, tariffs, we need to bear in mind, they reduce profitability. They also increase the friction that governments have as they try to work together. One of the things, if we looked, say, back 100 years ago, the relationship between France and Germany was not nearly as good. And the Second World War, because they didn't have as good trade relations, they could go to war much more easily. In 1950, when they set up a number of different agreements that they would work together and lower tariffs, well, now if you're a trade partner and you're very closely intertwined economically, you're much less likely to go to war with those folks. So we think about it, multiple levels. Again, the second thing that we'd say is it's not going to help companies' profitability. It's not going to help international relations. It needs to be a short-term perspective there. The final thing would be, the administration has chosen to say, hey, we're very concerned about the trade deficit here. And we just want to acknowledge up front, okay, there is a trade deficit that does tend to weaken a currency long-term. It does tend to also create some imbalances. Maybe there's some unfairness in terms of workers back home in certain sectors. But there's other ways to address this than simply tariffs. Among the economists that we listen to, we would much more tilt towards a policy of trying to weaken the dollar such that our dollar cannot go as far in buying other goods and services, and others' currency could go farther in buying our goods and services. And that would be another way that we could look at this trade imbalance and trying to rectify it. So tariffs are one way that can be done, that you can deal with the trade imbalance, but there are other ways that we hope the administration will pursue there. At the end of the day, tariffs are creating instability in the markets right now. We hope that the pain will be short-term, but it's anybody's guess in terms of where we'll go from here. So with that, hope that you found this informative, both in the first quarter review and some brief thoughts that we have in terms of where we sit on tariffs and where things may go from here, and our view of tariffs overall. If you have any questions, as always, don't hesitate to reach out to us. We'd love to talk with you further about that.
If you like these financial planning videos, please share with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.